Aaron Fragnito is a senior managing member and co-founder of People's Capital Group. He is the host of the New Jersey Real Estate Network and the Passive Cash Flow podcast. Aaron has taught real estate entrepreneurship at Rowan University and holds a bachelor's degree in business management from Rowan University. As the investments manager at Madison Trust Company, Donna Udamula brings a wealth of experience in the alternative investment industry. With her expertise, Donna helps clients achieve their investment goals through self-directed IRA accounts. And now I'm going to turn it over to her. Take it away, Donna.
Thank you, Deborah. Aaron, you can hear me well?
Yep. I can hear you just fine over here. And yeah, I'm excited to get started here, Dana. Very excited to get rocking and rolling. And I know you have some hard questions for me, so hopefully I don't get stumped here today.
We're planning on grilling you today, but I'm very excited about the conversation topic we are talking about today, building wealth with real estate. So how about we dive in, right?
Yeah, let's do it. Let's make it happen.
Perfect. So let's start from the very beginning, Aaron. So tell me, why did you decide to start a real estate syndication?
So I read a book called Rich Dad, Poor Dad when I graduated from college, and I was senior year of college. And as many people out there who've read this book, have you ever read that book, by the way?
Actually, I have. How funny is that?
Pretty funny. Yeah, no, a lot of people have, and it's a very common book. And what it teaches is how to pay yourself essentially using debt, how to refinance assets, and how the top 1% pay themselves to avoid capital gains tax and avoid tax burden. So I said, okay, that sounds pretty cool. I want to learn how to buy apartment buildings and buy real estate, commercial real estate, and refinance it to pay myself and not pay any taxes and make millions of dollars and not have to worry about money ever again and just go on vacation all the time. And so that's the life I live. No,
you're just speaking to me right now. My life, that's what I want.
That's what I want. Please give me that. No, I was really inspired by that. And I actually moved to Colorado to teach kids how to ski for 6 months. And I really figured out what I want to do with my life. I just graduated college. Yeah, it was 2009. The job market was dismal. Read a bunch of more books, David Lindahl, Trump University, kind of figured out, more about how to do a real estate fund. And they all explain how easy it is to start a real estate fund. So I made a list and I said, hey, I want to be, I have a net worth of $1 million and a passive cash flow of $100,000 within the next 10 years. So how am I going to get there? So I started to kind of work my way down the list. I said, okay, make connections, earn income, learn the business, meet investors, develop a brand, develop a reputation. So, okay, why don't I get started as a realtor, get my real estate license and learn how the deals work and start meeting investors that way. So I did that. I learned short sales and foreclosure properties and met Seth Martinez, my business partner. We bought and renovated and refinanced a 6-unit property in Newark, New Jersey. I found from stapling a sign to a telephone pole. And I said, hey, this works. You could buy it for a good price and renovate it and lease it up for top dollar, refinance your money out, create a cash flowing asset that creates tax-free income, pay yourself a big refinance check every few years. That's completely tax-free as well. And now I just have to figure out property management, which was the next challenge. So for the next few years, we developed our property management company, connected with more investors, built our brand, started to do our networking groups. And now we have about 150 doors, about a $25 million portfolio. We've also done a lot of fix and flips and wholesales through the years and kind of got into that space as well.
I love that. I love that you started from just the very beginning and you built something from the ground up from there and met your partner, Seth, as well. So is that the birth, that is how People's Capital Group was born?
Yeah, Seth and I did a deal together. We really worked well together. We proved the model. He had sold a medical billing company, so he was flush with cash. I was doing deals. I was running around as a young, hungry realtor, and I knew how to source great properties for great prices. And it's funny because other realtors didn't like working with Seth because he would submit lowball offers and get properties for pennies on the dollar. But I loved it. I was like, I love what this guy's doing. He's stealing properties. He's an aggressive negotiator. He's a good property manager. So, and I kind of had the gift of the gab and knew how to source deals and so on. So yeah, we really made a good partnership there. And the proof is in the pudding 10 years later. doing over 300 transactions together. I mean, obviously we don't see eye to eye on absolutely everything, but we have a respect for each other, and we know our roles in our business as well. And that's extremely important,
Perfect. So why do you focus on investing in New Jersey apartment buildings, Aaron?
Sure, Dana, I get this all the time, and it's so, why don't you go to Texas? You're a real estate syndicator. People tell me that every single day. They're very rude to me, very rude, as you can see. And
I
no,
love New Jersey, so I'm all about New Jersey.
yeah. And the answer is, listen, you can make money in Texas or Florida or Arizona or warehouses or Airbnbs or whatever it is. It's about the management. It's about the operators, right? If you're not a good operator, it doesn't matter how good a price you got on the property or how low interest rates are or how hot that market is right now. It really, your deals can still fail even in good markets. Ask other real estate investors. Some people lost money in the last 3 years investing in real estate. So in a great market for investing in real estate. So you've got to be aware of that. So basically, we've figured out a nice little niche here with a good infrastructure. We have our in-house property management company, right? This allows us to manage our assets very well. There's my property manager. I'm here in the PCG studio. Come on, Lee, you want to come in here?
We have a guest. We have a guest appearance.
Yeah, guest appearance. She's our property manager. She's managing the staff under her, all the contractors, leasing agents.
I love it.
Oh my gosh. And this is what it takes. This is what it takes.
Takes a village. Great meeting you.
Great to meet you. Bye.
But that's it, and that's exactly what we do here. So we have an in-house property management company, and that's really allowed us to have tight control of our assets, get our projects done faster, and also find great deals here with our connections with realtors and landlords and wholesalers, kind of source off-market deals. So yeah, you got to navigate the red tape. There's certain cities we don't buy in because they are so not landlord friendly, such as Hoboken or Jersey City. Even Newark, we're kind of leaning away from right now. East Orange, forget that. They hate landlords. So we don't go to cities that don't want us. But there are cities that are landlord friendly as far as, New Jersey standards go, such as Bayonne or, Plainfield, or, there's different areas in Morris County and West Jersey and Central that really have no rent control at all. So we want to look for that. And rent control changes city by city. So, how we handle our buildings in Patterson is different than one town over in Passaic. So yes, in general, New Jersey is a blue state, but there are cities that have more more fair rules for landlords, and we focus on those cities. And of course, our infrastructure, our boots on the ground allow us to execute well here. But the final reason we love New Jersey, Dana, is because it's just incredible. We have so much population growth here. There's so much people living in one of the most densely populated state in the country. We have New York City. I don't know if you ever heard of it. It's right there, the greatest city in the world. And we buy within an hour of New York City. Okay. We don't buy in New York City. We don't like the landlord rules there, but New Jersey, North Jersey has all these different cities that allow you to commute into Manhattan in 60 to 90 minutes. And we buy in those areas as we focus on. So, that's our specialty, kind of buying in those markets that play off the New York City metropolitan market, but aren't necessarily regulated by New York City landlord rules.
For sure. And of course, you know what they say, the Garden State, and we are live here from New Jersey today. It's a crisp 89 degrees.
Oh, it's beautiful. I'm looking out my window here. I'm like, what am I doing on this webinar? I just want to go outside.
Beach weather. Aaron, this is beach weather. It's a trip down the shore right now. That's what we need to do.
They should pay you double on nice days. I'll put that up.
I love that. Yeah. I think a lot of the audience would like that idea too.
Yeah, I like that. Yeah.
You briefly touched on something, and I'm very curious. Why did you create your own property management company instead of hiring one?
So we had hired 3 property management companies in the past, and one was a big national brand. They completely overpromised and underdelivered. Another one was a small mom and pop shop that we figured, let's go to small, let's get a personal touch. They ended up stealing money from us. We had to take them to small claims court and won $8,000. Yeah. So then we said, you know what, if we do this again, and I'd hired a management company in the past that just wasn't making the cut either. So 3 management companies down. If we cycle to a 4th management company and they don't work, our tenants are going to start losing faith in us and our investors, right? So we also recognize once it gets to about 50 units, it starts to make a little more financial sense to actually start to develop your own management company. Now, we didn't recognize how hard that was going to be and how difficult property management actually is. Now, I'm not just talking about collecting rent when checks due, or, collecting a check when the rent's due, or calling a plumber when the pipe leaks. I'm talking about buying mismanaged apartment buildings with renovations required throughout, uncooperative tenants with bad habits, taking a really nasty building and making it a nice building to live in, renovating it, dealing with the improved management, and making it a desirable place to live where people are willing to pay a higher rental amount. So it's a lot more moving pieces than just taking a turnkey building and collecting the rent when it's due, which I found most management companies really just want to do. The heavy lifting required in repositioning mismanaged apartment buildings and converting them into performing assets is a much heavier lift. And if you really want to do it right, you want to do it quickly and effectively and keep your costs low, having your own management company is key. So that's why we did it.
Perfect. All right. So let's go back to passive investing in real estate. So tell me, how does passive real estate investing compare to investing in the stock market? And I get this question a lot from a lot of people too. So what are your thoughts on that?
So, yeah, I mean, investing in the stock market is perfectly good strategy, but here's the problem with investing in the stock market. It's usually pitched to us as the end all be all, opportunity. I remember when I was graduating college, nothing against Rowan University, but my college advisor told me, and I love Rowan. I actually went back and taught a course there called Real Estate Entrepreneurship last year. So a big fan of Rowan, great university. But my college advisor, he's like, listen, I am an entrepreneur major, 22 years old, just graduated college. You sit down with your college advisor, right? You're like, well, what do I do now with my life? And he's like, just to get a job, the first place you can, because it's so hard no one's hiring right now. It's 2009. It's a dismal market. So his advice to me was go get a job like anywhere you can, work your way up the corporate ladder. And by the time you're 60 years old, if you put enough away in your IRA, put it into a mutual fund, you'll be able to retire. I'm an entrepreneur major, 22 years old. This guy is telling me to basically just do whatever you can to get a job and just work your way up the corporate ladder, keep your mouth shut, and just pile your money away into a mutual fund and hope it goes up. First of all, don't take investment advice from people who you don't want to financially be. Secondly, don't take career advice from people whose career you don't really want to be either. The right advice is actually, you don't have to pile just focus on your IRA, put it in a mutual fund. You can be more creative than that. There's alternative investments. You can self-direct your IRA into real estate. You can diversify part of your portfolio, 30, 50% of your portfolio into well-managed brick and mortar passive real estate investment opportunities. Doesn't have to be People's Capital Group. You can go invest in Grant Cardone. He's got a private jet, that's pretty awesome. So yeah, but either way, invest with good operators who have a good track record. Sometimes the private jet could be a red flag because your money's got to pay for that, by the way. So I like the guys without private jets.
Listen, Madison Trust, that is the sole purpose of Madison Trust. We are a self-directed IRA custodian because we believe in alternative investments. Diversify, diversify, diversify. What's the famous saying in the financial industry? You never put all of your eggs in one basket.
Yep.
There you have it.
Exactly. And that's it. That's 100% it, and that's why I was so, surprised by that advice. So really the right advice is diversify, have some money in the stock market, have some money in, mutual funds, bonds. But at the end of the day, I suggest really up to 50% or more of your portfolio should be invested in real estate. And my reasoning for that is not because I run a real estate fund. It's because 60% of billionaires' wealth is held in real estate, right? So their rule of thumb is generally 60%. Because of that, there's great tax benefits of real estate. So that's one of the reasons billionaires put their cash there. So we should probably follow what billionaires do if we want to become wealthy ourselves. So in my opinion, 60% of your portfolio, if it's in, professionally managed real estate syndications where you're earning cash flow, tax benefits, whether it's your IRA or not, and equity growth that's been, harvested over the years through refinances or sale of the properties, it's a great investment strategy. you could do much better than the stock market return wise. In fact, I mean, a lot of our investments are doing, 16% returns, 20+% annualized cash and cash returns. So the real estate market, you have the potential to have much higher returns. You also have it backed by brick and mortar assets. It's not a tech company. It's not a stock backed by real estate, where like a REIT, right, real estate investment trust that's publicly traded. If you owned a REIT when the pandemic hit in office space, your stock value dropped by 80% in about 4 days. If you owned an office building when the pandemic hit, your office building did not drop in value by 80% in 4 days, right? It might not be a great investment in the long run right now, but the bottom line is commercial real estate values move very, very, very slowly. And I like that. That leads to less volatility, more predictability. They just offer better tax benefits in general, and less volatility helps me sleep better at night. So that's why I'm pretty much 99% invested in real estate, which is not good financial advice because you should be more diversified than I am.
So are you seeing any market trends currently that you want to share with us?
Yeah, so obviously, we're seeing high interest rates. We're expecting prices to come down. I haven't seen it here in North Jersey. We have a huge amount of property demand, a huge amount of rental demand. If it gets more expensive to buy a home, most people end up renting, right? We're seeing the demand to buy apartment buildings and commercial real estate in general. Maybe not in the office space, right? Offices space is definitely coming down. There's no doubt about that. But apartment buildings, where we focus on, are very strong. We see consistent demand to buy apartment buildings, to rent the vacant units of apartment buildings. There's hedge funds, there's family offices, there's institutionalized capital that needs investment opportunities. They don't want to go into the stock market right now. The bond market's a little crazy. They're looking at, different opportunities in the multifamily space because they know that as it becomes more expensive to buy a home, more people rent. So because of that, in high demand markets like North Jersey, we really haven't seen prices come down. Now, the good news is there are less bidding wars. We're seeing less bids on properties we're bidding on. We're seeing them go for prices that are at or below list price, which is a more natural occurrence in a healthy market, instead of the 30 bids over list price, which is an unhealthy market, right? Which we've been seeing. Now we're more to a healthy market where you have buyers, you have sellers, and they're generally agreeing on a price around fair market value. Well, that defines fair market value, actually, what a buyer and a seller agree on. But you're seeing less bidding wars going on and a more healthy, a combination of buyers and sellers in the market. It's not so one-sided as it was for many, many years, a seller's market. So the trend is going towards a buyer's market. It's not yet a buyer's market. So what are we doing? We're holding tight. We're looking at deals. We're extremely, extremely picky, but we also just closed on a great asset just a couple months ago. And we're really focused on renovating that.
Oh, yeah.
Yeah.
So tell us more on that. So I was just about to ask you, are you still buying real estate in this current market? Because like you said, it is not technically a buyer's market. It is still a seller's market, but that supply has come up a little. Demand is, slowing down a little. So Aaron, are you buying real estate in this market right now?
Donna, I am always buying real estate. Okay. I'm always buying real estate, but I'm a very, very picky buyer. Okay. I'm the type of buyer realtors don't want to work with, right? Because I want to get deals for great prices. All right. And that's always how you should be buying. So what are we looking for right now? Assumable debt opportunities, right? In commercial real estate, you can assume debt on an apartment building. A lot of times that debt is 3% interest, something like that. So that the interest rate doesn't change when you assume assumable debt. So that's a great opportunity. Seller financing, right? The seller can take back paper, act as the bank, save money on income tax, and I can pay the interest payments to that seller. I got to pay it somewhere. Might as well pay it to him. All right. Seller financing can allow you to get a lower interest rate. Maybe instead of a 7% the bank's going to charge me, I get a 5% with a seller. And then, of course, you just have other types of opportunities where you simply have motivated sellers, right? People that have debt that's now becoming due to refinance, right? Like we take on 5-year notes, right? So 5-year, 30-year amortization but 5-year ARMs, right? That's a very common structure type of loan in commercial real estate. If you had a 5-year ARM 5 years ago, you're sitting at like a 3% rate. You're about to refinance or have to sell and have to do something because your rate's about to go from 3 to like 7.5. Those sellers are going to be motivated to sell. So you can tend to get a better price there. But again, it's all relative. If prices aren't really coming down yet, then those deals can be hard to get for great prices unless they're off market and you know the guy.
Perfect. And do you think anyone can just go and purchase an income property?
Well, yes, if you're qualified to, get a mortgage and you find yourself a nice duplex or triplex or 4-unit. Yeah, absolutely. I mean, listen, the first property I bought, I found through a wholesaler, bought it for $135,000 near Rutgers University in Newark, New Jersey. It was a 5-unit property, put another $60,000 into it. It's not about timing the market. It's about time in the market. Sure, I bought it at a great time for a great price and I kept my costs low on renovations, but I also bought it 9 years ago, right? So that's 10 years ago, right? So actually 11 years ago. So that's the real main factor. If the properties I bought a year ago haven't appreciated to that point, right? So it's about putting your investments into the market consistently, whether it's up, whether it's down, into good deals. And in time, the tenants pay down your mortgage, the value of the building grows as long as it's well managed and in a decent location, and rent goes up as well, especially in North Jersey, just naturally through inflation. It also really helps if you're in a nice market and improving the units. That's called forced appreciation, forcing the rent up, and then you have natural rent growth as well. But bottom line is, it's not about timing the market, it's about time in the market. So I'm always looking for good deals, but I'm very, very, very picky on what I'm buying right now. And I'm being very patient too.
You want to tell the audience on what the criteria you're typically looking for a good deal?
Sure. So we like to buy Class C and Class B real estate. And for people who don't understand what those terms mean, Class A is the nicest form of real estate, generally newer construction, higher and more expensive property. Class D is going to be your lowest rung of real estate. That tends to be more government housing, Section 8 housing, inner city real estate, older real estate as well. We find the best place, and many other funds recognize this as well, is right in the middle of the road, right? You don't want to be the fanciest guy on the block. You don't want to be the cheapest guy on the block, right? So we find a solid C+. Dana, we should turn that into a nice B, okay?
You were explaining about how you turn a C+, a solid C+, into a solid B.
Mm-hmm. And that's a great place for any real estate investor to be. I really suggest this because what's going to happen now as we enter a recession, Class A real estate gets hit pretty hard because of the most expensive real estate and people can't afford that in recession. Class D gets hit very hard because that demographic tends to be the first to lose their jobs or get demoted or things like that. So we'll run into financial hardship because the excess cash isn't there. So you really want to be middle of the road, working class families, white collar, blue collar, nice areas, desirable neighborhoods, nice buildings where it smells nice, it's safe to raise your family there. But we're not buying like the fanciest stuff for the most expensive price. We're also not going really, really cheap stuff in really rough neighborhoods because that is extremely hard to manage and doesn't grow in value or cash flow as it does on paper,
Perfect. So let's go back to People's Capital Group. So what is the mission for your company?
So People's Capital Group's mission is to help people build legacy wealth in real estate, right? A lot of funds out there focus on working with hedge funds or family offices or high net worth millionaires. And that's fine. Those are people too, and they need to put their money and keep it working and make more money. But making a millionaire more millions is fun and all. I have some millionaires that invest with us, but I actually get more personal pride out of helping like a school teacher or a firefighter or a doctor or a lawyer or a business executive or a business owner take, $30,000 or $100,000 in their IRA and self-directed into an apartment building with People's Capital Group, or a realtor that just got a big commission check and take $50,000 and make a cash investment in an apartment building. Those are the people I really take pride in helping. So we work with sophisticated and accredited investors, meaning you don't have to be a millionaire to invest with People's Capital Group. You could be a sophisticated investor, meaning you have experience investing in real estate or reviewing investment opportunities, and you have the minimum investment amount of $30,000 and don't need to live on the returns of the investment. So that opens up the door to a lot more people. And that's why People's Capital Group is structured, is fund to accept non-accredited, sophisticated investors. Okay, school teachers, firefighters, hardworking everyday Americans. So we also work with accredited investors, multimillionaires who have 7 figures with us, and we love their business, and we're more than happy to continue working with individuals like that. We actually don't work with family offices or hedge funds right now. We've had discussions with them, but it's just not a fit. So People's Capital Group mission is to also help people build legacy wealth. Now, this is another part of our fund that's really interesting. We don't kick you out of the fund at any moment, right? You can invest with us indefinitely, which is really nice. Now, you have exit options every 3 to 5 years where our investors can get back their initial investment and keep the proceeds from the investment, but then pay capital gains tax on those earnings. Now, of course, investing through a self-directed IRA, you defer all tax burdens, okay, all tax consequences. So that's a really nice product. You got to talk to Donna about that. And so, when you do that type of investing, though, when you invest your principal and you leave it in the building and investors keep getting quarterly cash flow from the building, large lump sums every 3 to 5 years upon the refinance, eventually we'll sell the building and trade into a bigger property through a 1031 tax deference, deferring all taxes and moving into a bigger property and building legacy wealth for our investors. And that's the key word there, legacy wealth, right? Wealth you can hand down to your heirs, or just, don't build a library, when you finally get there, right? Just be a Rockefeller, whatever you want to be, right? Make that difference in the world, donate $500,000 to World Vision, or St. Jude, make a real impact on this world. And you can get there by investing wisely through time. It's not going to happen overnight. It's not a get rich quick strategy. You invest what you can in opportunities as they become available. And our best investors put 30,000 here, 50,000 there, 100,000 there into opportunities they become available at People's Capital Group every 6 months or so. And those seeds grow into trees, and they harvest those trees over time. And what happens is you start to have so many seeds planted, so many investments paying out over time, that all those proceeds from those investments allow you to invest more capital. And it's just a rinse and repeat. You plant a seed to make an apple tree. Well, an apple tree makes like thousands of apple seeds, so it's just incredible. And that's exactly how investing works. So our best investors invest consistently. They take those returns from the investments and reinvest them over time. They understand the tax strategy of investing wisely and paying no taxes and keeping all the money you're earning and building more wealth with that money. And they understand, hey, you can't take it with you. So plan your estate the right way. And when it is time to hand it down to your heirs, or if you don't want to spoil your rotten kids, then, go build a library. But it's just incredible to have those options, and don't spoil your kids too much. I'm going to be guilty of that. That's going to be my problem. Yeah.
I like that you said that it's for the people, because really, Aaron, and this as well, that's why Madison Trust is here too. That's our core values: caring, collaborating, and empowering people. And with a self-directed IRA, real estate is something people can do. They can use their retirement funds to do, and they're not aware that this is a tool that they've never known before. Like, you don't have to just stay in the stock market. And of course, Madison Trust is a passive custodian. We don't provide any financial legal advice. We always tell clients, hey, speak to your financial professional and see what is best for you. But at the end of the day, consider all your options out there. So I love that you said it's for the people, not just accredited, also the non-accredited, and building that legacy wealth, that generational wealth. It's really so important, especially in this economic climate with everything going on. And we really don't know what's happening even. So that's fantastic. What's the future looking like for People's Capital Group?
Sure. So we really love what we're doing right now. We have over 100 investors that invest with us. We want to build that up to 200 investors this year. So that's our goal, is to reach 100 new investors this year. A lot of people like us because we're investing locally here in New Jersey. So I want to do a lot of things in the next few years. I want to keep investing in New Jersey inner cities and making a difference there, and finding mismanaged buildings that are run by slumlords and buying them, make them run by good landlords, make it a good place to live and have quality people move in and raise their family and have quality businesses and so on. And, you improve one building and the buildings around it improve. It's really a fantastic thing to see. And I also want to continue to bring really good off-market opportunities to our investors. One of the things they like about us is we find off-market deals. The one in Bayonne we just bought was a pocket listing. The realtor called us up and said, hey, I got a great deal, family owned for 40 years, rents way below market value, great location. You got 24 hours to deal, to give me this number, or I'm going to put it out to the market, and we strike on those and we bring those to our passive investors. And what's really cool about it is it's taken us decades to build these relationships. So that phone call comes in and says, hey, I got a hot deal in a hot market. You got 24 hours to move on it, or it's hitting the market. That phone call took a lot of work to get, and the ability to move on those quick. Yeah. And so to bring those deals then, and, vet them and bring these well-vetted opportunities to our investors who are doctors and lawyers and busy professionals who are never really going to have the time or the experience or the infrastructure to source those types of deals. I just love the amazing deals we can bring to them, the infrastructure we have in place to manage them long-term. And I just want to really fine-tune those systems, keep bringing great deals to our investors, keep overperforming on them. So when we are doing our project, we're under-promising and overperforming on the deals. I love doing that. And the feedback we get from people, one of my investors just said, hey, I put my kid through private school. I can afford private school. He didn't like what the school was teaching. His kid there, he wanted to put his kid in private school. And, I echo that. That's a whole different political conversation.
That's a different webinar.
Yeah, that's a different one. I got a lot to say about that one too. But so basically, he's able to put his kids through $80,000 a year private school because he's invested wisely with us for the last 5 years, and now has checks like that coming into his bank account every 6 months or so. And we're putting his kids through private school. So that's what I love about what I think. That's what I want to do. It's spreadsheets, it's dollars, it's cents, it's legal documents, but like, that's not what I love about my job. What I love is the people, the impact we have on their families, our investors, our tenants. We buy a building. Oh my God, the last landlord hadn't fixed my leaky dishwasher for 5 years. Thank God you fixed my leaky dishwasher. I now have a stainless steel, brand new dishwasher. I understand why my rent's going to go up a little bit. So
that's where were you when I was looking for a place, right?
Yeah. Yeah. Dishwasher guy saved the day.
I love hearing that feedback from investors, but so are you sending your kid through private school? That was a no, right?
No, I think, he's 1.5. So for now, we're just
a long way.
Yeah, long ways off. He everything goes in his mouth. So for now, we're just making sure he doesn't eat anything poisonous. Yeah. Mm-hmm.
That's always a fun age. Now, speaking of the people, our audience today have some questions. Deborah, do you want to see what questions they have for Aaron here?
Absolutely. We just got a question from Terry. Terry's asking about what are the tax consequences for red state investors?
So, I'll answer that on kind of the real estate side, and Donna, you could break in on the IRA side if that's the question there. So as far as the state you're from, it doesn't affect your taxes necessarily. I mean, there can be state tax and different things like that, but our investment strategy is structured to create no additional tax burden, right? So when you buy a building and you cash flow on it, which we do with our investors, that cash flow is written off with tax depreciation. It doesn't matter whether you live in New Jersey or Texas or California. The building in New Jersey here is giving you tax depreciation. That's generally about equal to the amount of cash flow you're earning. So you can write off your cash flow, and that's tax-free income. Then the big payday, the big profit center is the refinance, where you experience about 50% of your initial investment back. That's what our investors experience on the refinance. The best thing about the refinance, not only is it a big payout for our investors, but it's tax-free. Now, if you're invested with an IRA, it's definitely tax-free. But even if you're not invested with an IRA, as long as you leave your principal invested in the deal, it's tax-free. So for example, $100,000 investment, you'd expect about $2,000 a year or so in cash flow. That's written off with tax depreciation. But then you'd expect about $50,000 back at the refinance around years 3 to 5. Now that $50,000 is not diluting your ownership. You still have your 100 shares in the property. You still have your $100,000 initially invested in the property. You still have full ownership in the property. So that $50,000 goes right to our investors' bank account there, but it's a non-taxable liquidity event because it's debt. We're not selling the building. It's not cash flow. It's debt. Now it's good debt. It's low interest debt at an amount that the bank won't give us more of a mortgage than the property will qualify for. So it's a safe amount of debt. It's debt that's signed for by Seth and I, so our investors don't have to personally guarantee it. But debt is non-taxable income. And in commercial real estate, that's how billionaires pay themselves, using debt, refinancing strong assets, not over leveraging, but pulling out a healthy amount of debt on the property to pay themselves tax-free. Now, if you want to exit the investment, if you're not invested through an IRA, you can exit the refinance, get back your initial principal investment, and then pay capital gains tax on the cash flow you've earned and the refinance capital you've earned. However, if you're invested through an IRA, if you contact Madison Trust today and get your IRA structure with them to self-direct into real estate, then you can defer those taxes and invest in more assets and build your wealth exponentially faster than not investing through an IRA.
You know, I don't even need to be here. Aaron is good at my job too. Aaron's great at my job.
Well, don't go anywhere just yet, because this next question, Donna, came in specifically for you. And the question is, please explain Madison Trust's process for investing in real estate with a self-directed IRA.
I love this question. I get this all the time. It's a great question. So the process is very, very simple. It's a 3-step process: open, fund, invest. So you set up a Madison Trust account. It's a 10-minute process with the online application. You transfer funds or roll over funds from an existing IRA or a 401k, wherever you may have retirement money right now. While doing that, you're going to contact me and you're going to let me know, Donna, this is what I want to do. I want to invest into a real estate syndication deal, or I want to invest into a real estate. Like, I want to actually hold a tangible property in my IRA. I'll be like, great, I can help you with that. If it's a syndication, we'll definitely need the documentation associated with the syndication. It could be a private placement memorandum, a subscription document. If it's an actual tangible property, we'll need the whole thing, you know, the purchase contract, the HUD, the draft of the deed. Again, my team is great at walking clients through all what we need. We'll review them for compliance. We'll make sure everything is in good order. And after that, the last step is invest. We will just need one more form filled out on our end. It's called an investment authorization form. Basically, you as the client will tell us, Madison Trust, please invest into this deal or this real estate property on my behalf of my IRA. And that's it. And it's a wrap. The great thing about this, as Aaron said, is depending on the type of IRA account you create, it could be either tax deferred or tax free. And you can just sit back, relax, and watch your account grow.
Thank you. Okay, the next question also came in via email from Bridget. She wants to know, what is a piece of real estate that people typically overlook?
Oh, Aaron, do you want to try to tackle this one?
Oh, wow. It's got real estate in it. Sounds like right up my alley. So, a piece of real estate people often overlook. I mean, honestly, real estate's a pretty popular industry these days. I don't know if you heard of it. Yeah, most of the, like, it's the cool thing to do now is be a real estate investor. You know, it's even cooler to be a real estate syndicator. So unfortunately, I got a lot of competition these days. But you know, self-storage is a place that I see a lot of value in. People just accumulate so much junk, especially in cities where there's really not a lot of space. They need a place to put their storage, so their junk. So we put self-storage units in our buildings, in our basements, which is a great way to build another revenue stream into your building. Great real estate tip there. So I like self-storage. A warehouse space. As online shopping becomes more and more popular, warehouse space is something that I think it could be a good investment in the right areas. Okay, you don't want to buy a warehouse in the middle of nowhere. New Jersey is a great place for that. Don't even look at Donna's Amazon account. It's just endless. And but I'd steer away from office space right now, retail, Airbnb, you could be very creative there, so I don't know if that's overlooked necessarily, but that could be a place where you can find value. My favorite is, of course, multifamily housing. That's definitely not overlooked. That's really the primary opportunity. But here's one might be overlooked. Office space that's vacant, and you can convert that into multifamily housing, right? There's a serious problem we have right now all throughout the country is that we kind of have a lot of office space that's just kind of sitting there. Like cities like San Francisco, 25% of its office space is vacant. So there's a lot of buildings just sitting there vacant. But the housing crisis in San Francisco is through the roof, right? There's not enough housing. The cost of housing is crazy. Homeless people everywhere, crime rampant. So the solution is more housing to bring the cost of housing down. So converting those vacant office buildings into condos and apartments could be a great play there. That's something we're kind of looking into as well. So that could be an overlooked space of the real estate market.
Thanks for taking that one. The next question came in from James, and he's asking, how long does it typically take for a deal to close?
So as far as on our end, for beginning to end, it is a process. Buying a commercial piece of real estate, lining up the mortgage, putting all the investors together, selecting who's going to be investing how much in our fund, developing the new fund is a bit of a process. Generally, it's about a 6-month process from the time I'll get the phone call on the deal, do our due diligence, submit a letter of intent, an LOI, go into contract, put up our next level of due diligence, put up our deposit, get our mortgage lined up. All these things take time. We try to do them in 90 days, but the truth is, to manage your expectations, I'm going to say 6 months. Now, the good news is, while our investors are pooling capital as we get closer and closer to closing, those funds are held in a money market account. And right now that's paying like 4.5% annual interest. So it's actually, the money's not sitting there doing nothing for the 6 months we're moving to a closing table. It is in a money market account, earning like the most you can earn in a FDIC insured account. JP Morgan is usually where we put it.
Okay, great. I think we have one more question today, and that is, what is a new deal that you are excited about and why?
So unfortunately, the SEC does not allow me to talk about any current investment opportunity. Okay. What I can say is we just purchased a building in Bayonne, New Jersey. It's a beautiful building with rents 35% below market value, great location, 3 blocks to the water, 10-minute walk to a light rail station. They're building a ferry from Bayonne to Manhattan to cut that commute time in half to about 20 minutes. And we see a lot of momentum in that market. They're building about 500 Class A units, 3 blocks from the building we just bought. Now, remember, we're not Class A, so we're not even going to compete with them. We're going to underprice them as Class B units right around the corner. But just a great location, a great market to be in, landlord friendly compared to other neighboring cities. Beautiful building, family owned for many years. The renovations are really just upgrades, cosmetic upgrades, giving it the current whistles and bells tenants are looking for. So a deal like that's a beautiful location, and our investors are participating in that and investing anywhere between $30,000 to over $300,000. Now, what we do on a deal like this is sometimes we leave a couple spots open for new investors to start building new relationships, because I know if I don't have an opportunity to invest your capital in, then there's a good chance you're going to go invest elsewhere. So we like to always keep a couple spots open on past properties that just closed, and that allows investors I meet through webinars like this to do the discovery call, get qualified to invest with us, do their due diligence, and if it's a fit, move forward on the investment opportunity and start building their wealth in real estate. But there is a qualification process, and I can't say if there are or are not spots available on this opportunity, because that would be a solicitation for capital. What I can tell you is it's a beautiful property. If you want to learn more about it, we got to have that discovery call. And if all the spots fill up in this, we're going to have more opportunities coming up in the very near future. So your best bet to learn about opportunities with us is to do that discovery call, get qualified, and then you can start digging into past performance, current opportunities, and anything coming up on the horizon.
Okay, thank you for answering it that way. And thank you to both of our speakers for sharing your expertise with us today, and to everyone who attended today's webinar. Have a wonderful afternoon.